See, in trading, our goal is to buy the right stock at the right price at the right time. This is very important because sometimes we get the stock right, but we might get the price or the timing wrong. For example, if we select a stock based on our criteria, but when it comes to execution, we end up buying the stock prematurely. So, for example, this is the buy point. If I buy the stock below the buy point, that's a premature purchase. I have to wait till the stock reaches that yellow line, which is our buy point on the chart. Or if I buy the stock above the yellow band, okay, there are two yellow lines in which I'm supposed to buy the stock. If I buy the stock above that yellow band, I am buying an extended stock. So sometimes what happens is we select the stock correctly, but we mess up in our trade execution. On the other hand, we might get the price right. We might buy in that yellow band, but the stock selection itself is a problem. It has some weaknesses in some of the areas which we look at. For example, liquidity, comparative, technical, fundamental, and market analysis. Right? So the goal of a trader is to buy the right stock at the right price and at the right time. Okay. Which means trade execution is extremely important. This video is about trade execution. Okay. So have a look at this. This is the basics of our trading system. I created this point system for myself to simplify the understanding of a base of a stage 2 confirmed uptrending stock. So there are three steps in this strategy. Step number 1 is this high volume rally. Step number 2 is this low volume consolidation, and step number 3 is the high volume breakout from the buy point. These are the three steps. When you are practically trading, you only get to see step number 1 and step number 2. You don't get to see step number 3, which is why we need to master step number 2. We need to properly learn to identify the step number 2, which is a low volume consolidation. Okay. That is why I created this points system. It simplifies the identification and marking of the base. So as you can see here, points 9, 7, 5, 3, 1, these are all our buy points. The lower the better. As you can see here, point number 9 is lower than 0.7, 0.7 is lower than 5, 0.5 is lower than 3, and so on. Okay. All of these are our buy points. The lower the buy point, the better is the price that we are getting in this stock. Okay. That is what we follow. Let us look at an example of this. It is very important to buy a stock as it is crossing that yellow line from bottom to up on high volume. Okay. The problem happens when the stock opens above the yellow line. That's a big problem because if the stock opens above this buy point in the morning, and if you buy, you're probably buying an extended stock if it has opened above the yellow band. Or if you had already placed your order here to buy the stock, let's say you placed an automatic order to buy the stock, when the stock opens above that buy point, if it starts to drop, it will first trigger your buy point. You will get the shares. Okay. And money will be deducted from your account. Correct. So you are actually buying a falling stock. That could be a trap. So let us look at an example so that it will help me to explain this to you properly. So I am taking the example of Tesla. This is an old chart, as you know. As always, we have to show old charts. So let me open the, okay, have a look at this base. This is a stage 2 uptrending stock. The only problem here is the price has closed below the 50-day simple moving average. Nevertheless, stage 2 does not mean that the price has to be above the blue line. Stage 2 means that blue line is above the green line and the green is above the red line. Okay, so blue, green, red, 50-day, 150-day, 200-day. That's the required criteria. There is a difference between required criteria and preferred criteria. The preferred criteria is the price should be above the blue should be above the green, and the green should be above the red, and all the moving averages should be sloping up. That's the preferred criteria, this in a strictest sense. Okay. So let's first draw this base, and I will draw uh, these points on the base, and I will identify the buy points for you. So from here, I draw the base like this. So let's complete the points. Let's draw the path. So this is point one. Remember, we go from highest to lowest to highest to lowest and so on. So point one, point two, point three, point four, point five, point six, point seven, point eight, point nine. Okay. So there are 9 points in the base. Now let me tell you, 9 points or 10 points in the base is extremely rare. Even 8 points in the base is very rare. Most of the times, like 90% of the time, you will see 4 points in the base or 6 points in the base. 8 points in the base is very rare. 10 points in the base is very, very, very rare. Okay, so in this case, you have point number 9 in Tesla's case, but you don't have point number 10. Okay, but there are still 8 points in the base. So even though the price is below uh, the blue line, there is still some juice left in the stock because the retail supply has contracted so much that it has ended up creating 8 points in the base. Okay. So point number 7 obviously is the buy point. Point number 5 is the buy point. Point number 3 is the buy point. Point number 1 is the buy point. So first let us draw a yellow line at point number 7. Okay. So I will remove this. The high of this candle is point number 7, which is 141. So let me draw a line there, 141. Okay. So our goal is to buy the stock as it is crossing the yellow line from bottom to, to the top. Okay. Now, as you can see, the yellow line in this case is in the blue zone, but the gray dotted line is in the red zone. What does that mean? That does not mean I just reject the stock. It simply means that the risk in the stock is slightly or relatively higher. Okay. I look at every situation from a risk management point of view. I prefer that the price should be above the blue line, the blue should be above the green, and the green should be above the red, and the blue, green, red should be sloping up. Okay. If that is not the case, then the risk in that stock is relatively high. That does not mean that I will outright reject the stock, because at least you have the blue, green, red, right? Plus, there are 8 points in the base, which is a very, very rare phenomenon. Okay. 8 points in the base is, you would get that once in 3 months, maybe. This is my experience, I'm telling you. It's very rare. Okay. So in this case, you are getting that 8 points in the base, but you can see uh, there are risk parameters here. The yellow line is in the blue zone. The gray dotted line, which is the closing price, is in the red zone. That adds to risk. The price is trading below the 50-day simple moving average. That is adding to the risk. So you need to understand what you are getting into. Okay. So let's see what happens. Remember what I told you. If you buy the stock below the yellow line, you are buying it prematurely. If you buy the stock above the yellow band means there are two yellow lines here. One yellow line is here, another yellow line is 1% above that first yellow line. If you buy it above that yellow band, you are buying it extended. So you have to buy it as it is crossing the yellow line on high volume. Okay. You will check high volume on lower time frame charts. So let's see what happens next. Where does this candle open? The candle opens above the yellow line. Okay, so whenever the candle opens above the yellow line, by default, it is extended. Okay, now sometimes what happens is the candle opens inside the yellow band. Okay, even that for me is extended. I may buy, but even if I buy, I will go in with a small position size. I want the price to properly open below the yellow line, start moving up, on 5 minute, 15-minute time frame chart, I want to see good volume coming in. And as it is crossing that yellow band, during that transition, I want to complete my purchase of all the shares that I have planned to purchase. So in this case, with the appearance of this candle, obviously I'm not going to buy on this day because it opened above the yellow line. And let's see by how much percent it opened. So this is trade execution. See, it opened like 9% above the yellow line. Okay. 9% above the yellow line. No, that is not acceptable. That is not how we buy a particular stock. We have to buy as it is crossing that yellow line. It's too extended in price. Okay. So, what to do next? Remember, I showed you this diagram 1, 3, 5, 7, 9. All of these are buy points. So, in Tesla's case, we have point number 7 and point number 5. Both of them have become invalid now. Okay. Now, if I draw the base, look what happens. So, this is point 1. That's point 2. That's point 3. That's point 4. And that is point 5. Agreed? As per this diagram. Earlier, we had 9 points in the base. Now we have only 5 points in the base because the structure of the base has changed. This sudden candle has changed the structure of the base. We have gone from 9 points to 5 points in the base. See, this is the beauty of the point system that I have created. It automatically adjusts to the price movement. And just because it has created, just because it has created uh, the rising window doesn't mean that you get excited and you buy the stock. No, no, no. We have to buy the right stock at the right price at the right time. Okay. My voice is slightly low today because I just woke up. I like to have uh, afternoon nap. So I just woke up from my sleep. There was nothing to buy today. But anyways, I'm not allowed to discuss all these things due because of SEBI guidelines and things like that. Anyways, coming back to the chart, this is point number 3, right? So let me draw a line at point number 3, the high of this candle, which is 155.30. 155.30. Okay. So now you have 5 points in the base, correct? I will remove this yellow line. Now tell me if this price crosses the yellow line from below to the through the yellow line and up, does it satisfy our 3 steps? Step number 1 is high volume rally. Step number 2 is low volume consolidation. Step number 3 is high volume breakout. Does it satisfy that condition if it crosses properly? The answer is yes. Okay. However, there is still one problem with this base and with this buy point. Notice that the yellow line is in green zone and the buy point is in uh, blue zone. Okay. Remember what I told you a couple of videos ago? If the yellow line is in the green zone, preferably our closing price, the gray dotted line, this one should also be in green zone. And if the yellow line is in the blue zone, preferably the gray dotted line should also be in the blue zone. Okay, that indicates tightness in the base. That indicates that the retail supply has vanished from this stock. Okay. One good thing that has happened here is the price has gone above the 50-day simple moving average. The price has gone above the blue line and the slope of the blue line has moved up. Okay. So if we look at everything from a risk management point of view, I will tell you what is in our favor when it comes to risk and what is not in our favor. What is in our favor is the price above the blue above the green, and the green above the red. That's in our favor. Another thing that is in our favor is that we have a clearly identified buy point on the base. What is not in our favor when it comes to risk management is yellow line is in green and the closing price is in blue. Another thing that is not in our favor is the distance between the closing price and the yellow line should preferably be 5% or low. because we want tightness. So it is 5.19. Okay, that's not ideal. It should be, even if it was 4.85 or something, I would have accepted that. Okay. But 5.19 means there is slightly some additional risk we are adding when we are taking this position. That is something which is not in our favor. So 2 points not in our favor. The yellow line in the green and the gray line in the blue zone. Then the distance between the closing price and the buy point is more than 5%. There are 3 4 points in our favor, including the point that the price has now created a rising window, that too on high volume. Okay, that is strongly in our favor. The reason why I am showing you Tesla's chart is because after this base, the stock shot up 93% in a very short period of time. That is why the VCP concept that Mark Minervini spoke about in his book, Trade Like a Stock Market Wizard, it is so powerful that the more stocks you study which have displayed VCP characteristics in the past, the more confident you will be while using this strategy. By the way, remember what was step two? I said low volume consolidation. Can you see low volume consolidation here? Look at this gap. Almost all of these candles or all of these volume bars are below the blue line, which means the shares are going from retail hands or weaker hands to the institutions. So there is institutional accumulation happening inside this base. I have made a separate video on what happens behind the curtain when this base is getting formed. Okay, you can watch that video later. I forgot which video was it was. Okay, you will find it on my channel. Now let's see what happens. See, the breakout happens on high volume. So let's say the second yellow line is somewhere here. So during that transition, we expect to buy the stock, and our average execution price should be between those two yellow lines. Okay. In the daily chart, the distance between the two yellow lines might look very small, but when you go down to the 5 minute or the 15-minute chart, you have enough time to buy the stock. You get like at least 10 15 minutes to buy the stock. And remember, I told you the stock shot up 93% after this uh, tight contraction. Although we missed points number 7 and point number 5, we could not buy it because the price was not right. Remember, the stock was right, but the price was not right. We could not buy it, but at least we could buy it at point number 3. Okay. So if you had bought the stock at point number 7 or point number 5, that was a wrong decision from a trade management and a risk management point of view. If you bought the stock at point number 3, that was a correct decision from a trade execution and risk management point of view. Now I will extend the price. Okay, look what happened. I will click here. Look at the price. This is the power of the VCP concept. The stock shot up like 93% in how many days? Maybe couple of months, 3 months. Don't know. From November it started. 18 November 2022 it started. And look where it went. So let's see, from 18th of November, see that's like 92% from November to January. So December, January, in 2 months, the stock almost doubled. That's the power of the volatility contraction pattern, which was documented by Mark Minervini in his book. It is very important to study the pattern, but it is equally important to properly identify the buy point and correctly execute the trade while keeping a manageable stop loss. Okay, let me repeat that. It is important to buy the right stock at the right price and at the right time. Okay, and all along this uh, journey, the stock continued to trade above the 50-day simple moving average. So that's the base I wanted to discuss with you. I wanted to discuss granular details with you because these are important. If I buy the stock on this day, let me come back to that. If I buy the stock on this particular day, I am buying a falling stock. I am not buying a rising stock. Remember that in our breakout strategy, we expect the stock to open below the yellow line. We expect the stock to start going up on high volume. We expect the stock to give us some time window to buy the stock, and we expect the stock to close above that yellow band on high volume on the closing of the breakout day. That is what we expect the stock to do. As long as the stock is doing what we expect it to do, we have to hang in there. If the stock does not do what we expect it to do, we just sit on cash, relax. There is nothing to, I mean, there is no hurry here. Okay. So I hope this video has added value to your trade execution part. Remember, everything boils down to the orange trading system. See, whatever I discuss with you, ultimately, I continue to refer to the, wait, let me open that, where it is. Yes. Let me open that orange trading system diagram for you. Yes. So what we have discussed today is trade execution part. I have not discussed these gray circles. This is stock selection criteria. The what you see in the middle, that's stock selection. Position sizing, risk management. What we have discussed today is trade execution. You have to get it right. And remember, this is a flow chart. This is not just a diagram, it's a flow diagram. Liquidity comes before comparative, comparative comes before technical. There is a reason why I placed these items in a certain way. You have to check liquidity before you check the comparative. Okay. And after you have already determined the position size, then you go to trade execution. Okay. So, whatever I discuss on my channel, ultimately everything is going to boil down to this orange trading system. Thank you so much.